Welcome to this week's market drama. We'll start with the S&P 500, which was up 2.3% for the week. NASDAQ was up even more, up 2.9%. They're both now above 9% year to date. And in fact, this is a week where NASDAQ, S&P, and Dow Jones were all up more than 2%, right? So the major stock indexes are all moving up higher. And when you look at sector representation, the rally is broadening, right? You had sectors like industrials, energy perform well alongside the usual suspects like technology. So what's going on this week that drove markets to rally? Well, most of that rally happened after Wednesday because the catalyst was the FOMC meeting the Federal Reserve had. And in this meeting, they didn't change where interest rates are currently, but what the market was looking for was any signal around future interest rate cuts. And it was fairly dovish on its communication. The key message here being that the economy is moving along just fine. Inflation had some noise earlier this year in the sense of like the trajectory kind of changed a little bit to upwards rather than downwards, but they're not necessarily super concerned. And they're kind of forecasting via their dot plot that they're looking to cut rates 3 times this year. So that was all positive for the market. You throw in the fact that they upgraded their outlook for real GDP growth this year from 1.4 to 2.1. It's kind of the perfect scenario, right? Markets love a scenario where the economy is still doing well, if anything, kind of reaccelerating a little bit its growth. Inflation looks fairly benign and still coming down, and the Fed is at high interest rates and looking to cut interest rates, right? So that's why the market rallied. Something to keep in mind is something I mentioned when I went on CNBC last week is that I actually don't think that the Federal Reserve needs to cut interest rates this year for the market to continue to go up higher. Because if the Fed doesn't cut interest rates because the economy continues to do really well, and sure, maybe the inflation gets stuck a little bit between 3 and 4%, that's not enough to derail markets. And the reason is that earnings have delivered so far. If anything, earnings revisions are moving upwards, and earnings is what markets care the most about. Once the more macro numbers like interest rates and inflation start to normalize, they do tend to focus more on earnings. So if earnings deliver, I don't think the Fed needs to deliver as much on lowering interest rates in the current time frame. And the reason that I mentioned this is that it's kind of happening that way already. Right. In December, expectation was that the Fed was going to cut interest rates in March. We got to March, they didn't cut interest rates. Market's still all-time high, right? But they're signaling that at some point they will, and that's enough for the markets to not focus on it solely on inflation and interest rates, but start focusing more on earnings, which is the true driver long-term of market performance. That is it for this week. For next week, we have PCE inflation data, which obviously is very important. So we'll stay tuned for that one. All right, take care. See you next week.